Okay, so no matter at what stage of financial education we all are, I think we should understand by now that the lower the interest rates go, the higher the prices of bonds or property go. That's really, in a nutshell, the relationship between interest rates and the assets that are purchased using the credit. I mean, that really has to make sense to most people that, the lower the interest rates go, meaning that the lower the repayment is going to be, the higher price of a house you can afford to buy. But the same thing goes with the bond market when they talk about the yields. So bond yields go down, bond um, value goes up. So you can think of a bond same as a house. So with that in mind, if we were to say that we expect for interest rates to drop, that may mean that the prices of the housing will continue to go up. If the interest rates are to rise, which I think they will after a final dip, then the prices of those assets that were purchased using credit with those interest rates will fall, because fewer people will be able to get loans that will pay for those prices. Hence, something has to give, which means that the price of the asset, i.e., house, is going to have to go down. Here's one of those lovely charts. So uh, the blue line is Australian median house price, where most importantly we want to start with the home loan interest rate. So we see that it's going up and down, but the trend is definitely down. So the trend here is showing from December 86 down to December 2017. So we got plenty of data there to go by. So the trend of the home loan interest rate is down, the red line, while the trend of Australian median house price is, as we all know, up. So if that reverses, if that starts going down that way, meaning that, oh, sorry, that home loan interest rates go up, then that means that the housing is going to go down pretty much proportionally, or in some sort of an inverted correlation. Why am I saying all this? There's an article I just read recently, which I'm going to show you or read part of it. The reader at Martin Armstrongeconomics.com wrote in and said they pretty much went into the bank, asked the advisor, and said, "Hey, we want to fix the interest rate because Martin Armstrong believes that these are the lowest rates that they can only go up, and there's a repo crisis brewing because of this, because they're trying to suppress interest rates from going up. So they're really manipulating the interest rates to the downside, but they will have to pop up. So the person has gone into the bank and said, we'd like to fix it. And they said, hey, don't worry about it. Just leave it floating. I think the person's in Europe, obviously, they're talking euros. But I think the similar situation is in America, where you can actually fix it. In Australia, I think you can only fix it for default is kind of 1 year. I think then 2 years, 3 years, or 5 years. I don't know if you can do longer than that. But in any case, if you believe that the interest rates are going to go up, you want to fix the interest rates now when they're low, so when they go up, yours doesn't go up. If you do fix it now when they're low and they go even lower, but you locked yourself into that higher rate, then you've lost. So um, they told this person to not fix it, to just wait until November 2020, because that's, I think, when some sort of term is expiring. But they can fix it now if they want to, but they were talking them out of it. So the answer is much better than the actual question, because the question is kind of confusing, but I know what they were trying to say here. So good old Martin Armstrong here, Martin Armstrong says following. So he says they may have been instructed from above to keep loans floating because the repo crisis is demonstrating that rates are under pressure to rise, not fall. Exactly what I said before. And obviously, I didn't come up with it myself. It was the Martin Armstrong's writings that have kind of opened my eyes as to what could be coming next. So the bank is saying, don't fix it, that's okay, but they probably know that the interest rate is going to be so much higher, towards the end of 2020. And the repo crisis is that there's I was going to make a video on its own. From what I understand, repo crisis is, or market is a lending facility between the banks overnight, and very short-term lending that has spiked up to 10, 20% overnight, because banks don't trust each other and they expect interest rates to potentially rise at any moment, in which case whoever's lent the money to the other bank at a lower rate will be holding the bag because the real interest rates have shot up. So what the central banks, and in this case Federal Reserve, is doing is pumping the liquidity not as a quantitative easing into the market, but what they're doing is they're pumping into this overnight lending facility. So if the banks don't trust each other in between each other, they're stepping in as the mediator and saying, look, we'll give you the money, but just don't start trusting each other. Don't demand higher rates when you lending to each other. Look, we can lend you for less. So they're just suppressing the interest rates to the downside, so it doesn't go up. It means that once this blows up, once you've pushed the balloon under the water, or the ball under the water as far as you can, the more you push it down under the water, the bigger and the stronger the pressure is to bring that balloon up and shoot it up into the air. So he goes on to say, if you have a mortgage that is floating, lock it in with a fixed rate. So again, once more he's saying the interest rates will go up no matter how much they try to manipulate it. Continuing, those looking to buy have a dilemma. On one hand, real estate prices are high in many regions, and you can wait for prices to come down before buying. On the other hand, when prices start to tumble, it will be the result of an inability to get long-term fixed loans, so prices will fall to where people will be able to get loans or pay cash. The solution may be to buy when you can get a long-term fixed mortgage and then hedge it with eventually shorting rates where there will be a liquid market. So this is brilliant. It took me a few times to read this. The solution may be to buy when you can get a long-term fixed mortgage and then hedge it with eventually shorting rates where there will be a liquid market. So what does this mean? Once again, is that buy it, get a long-term fixed interest rate, mortgage rate, and then when the liquidity dries, no one's able to borrow money because the interest rates have gone up or they're on the way up, you want to short the interest rate. So from my understanding here is that he wants you to buy some sort of a vehicle, financial instrument or financial product that will make you money when interest rates go up. That's how I understand it. So when the interest rates go up, you got this product that goes up with interest rates, so you made money there, and it kind of covers the fact that you bought this overpriced property, but you did fix long-term fixed mortgage, which means that when the interest rates go up, your interest rate on your mortgage didn't go up. So it's really a win-win situation here. I hope I didn't confuse everyone, because I was getting confused myself, and it took me a little while to read this very short article, to which obviously I'm going to post a link in the description below. And yes, as I mentioned in my previous video, I'm going to create one with the list of high yielding online saving accounts in Australia. And yes, one of the viewers made a comment, CUA is one of them on the list. There's about 3 others. So stay tuned for that video that's coming up. Otherwise, thanks for watching, and we'll talk again soon.